in the early 80s, when Fed Chairman Volcker was trying to strangle inflation out of the system with double-digit interest rates, inflation was also at double digits. So if he was going to make a mistake, that was a big buffer to make a mistake. Our inflation rates today are much lower. And so the Fed actually has less room for error. And I do believe that higher for longer and thinking that inflation was the big risk out there has put us somewhat in harm's way.
When the U.S. Federal Reserve began raising interest rates at an unprecedented pace in 2022, many financial experts, prominent hedge fund managers, and legendary investors warned that the central bank's actions could lead to significant disruption, potentially plunging the global economy into chaos. Despite these concerns, the Fed not only continued its aggressive rate hikes to combat inflation, but also maintained high rates for an extended period, consistently signaling a hawkish stance to the markets in an effort to maintain control. As Federal Reserve Chair Jerome Powell cautioned during his 2022 Jackson Hole speech, where he frequently referenced former Fed Chair Paul Volcker, Americans are now feeling the full impact of the Fed's policies. This pain is rapidly spreading to other major economies. For instance, last month, the Japanese yen hit a 38-year low against the US dollar. Higher US interest rates are prompting investors to sell yen and purchase US treasuries, which offer higher returns compared to Japan's low-yield government bonds. This creates a self-reinforcing cycle, pushing the yen further down despite recent interventions by the Bank of Japan. The Japanese stock market has become increasingly volatile, experiencing record lows one day and significant gains the next. American consumers are also struggling, as prices remain high despite reports of slowing inflation and rising wages. In a recent episode of Her in the Know broadcast, ARK Invest founder, CEO, and CIO Cathie Wood expressed her belief that these developments signal even greater challenges ahead for both the US and the global economy. Cathie predicts that the US, and by extension the global economy, is on the brink of a deflationary decade characterized by falling prices and slower economic growth. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
And one of the things you'll hear about increasingly in the news, I think, is the idea that the carry trade, which involves, believe it or not, the yen, is unwinding. So if you look at the carry, what people mean by the carry trade, it means that many investors and speculators borrowed yen. So they were effectively short yen. They borrowed yen because the interest rates in Japan were so low relative to the rest of the world. So they borrowed there and then redeployed those assets, put them into dollar-based assets or other currencies, but primarily dollar, often into our treasury bonds, which were yielding more. Now, since 2011, the yen has either been depreciating or stable. And so it was kind of safe if you were making the bet to short the yen or borrow the yen, you weren't taking that much risk. And in fact, if the yen went down, you got the benefit of that, plus you were earning higher rates in the US. Some people think that part of the carry trade was by borrowing yen and then buying the Mag 6 or one of the broad-based benchmarks in the US, the S&P 500, the NASDAQ 100, both of which are very heavily populated and weighted with the Mag 6. So again, that we don't know how much of this went on. There are some guesses. A Deutsche Bank study suggested it could be $20 trillion. Now, think about that. Our GDP is roughly $25 trillion. So can you imagine this carry trade, which was becoming a consensus trade, to the tune of $20 trillion? I don't know if that's true or not. The other way to put it in perspective is I believe the global equity markets today are priced at roughly $130 trillion. So $20 trillion in the context of $130 trillion is also a very large trade in the market. So we don't know the exact number. It does make sense watching how violently the yen is actually appreciating now that this carry trade is unwinding. So people who had bet on the yen continuing to depreciate are changing their spots. They're cutting their losses, or they're getting margin calls and are having to sell. They're forced sellers. Now, the other thing that could be going on, just trying to understand what else could be going wrong out there, we've tried to figure out, okay, where is the biggest leverage out there? And that carry trade certainly was leverage. So that's, yes, one source of leverage. Another is private equity. And this is where commercial real estate, and especially multifamily in the United States, could be instructed.
Cathie would predict a slowly, then all-at-once scenario for the global economy as it undergoes the massive unwinding necessary to reduce the significant leverage within the system. While she anticipates this unwinding will be more controlled than the great financial crisis, she foresees it leading to a prolonged period of deflation, which will put pressure on profit margins for consumer-oriented companies. According to the ARK Invest CEO, innovation will play a crucial role in addressing these margin challenges, driving substantial productivity gains. Wood also notes that disruptive technologies, such as artificial intelligence and robotics, may lead to higher unemployment in the short term. However, she believes that their long-term benefits will more than compensate for these losses, helping the global economy return to a path of growth.
Monetary policy, the other thing that came out of the Bitcoin discussions we had in Nashville is, yes, Bitcoin could be a private money, taking us back to pre-Fed days, so pre-1913. Private money competing against, in today, public money, the dollar or other fiat currencies. And because of the rules-based monetary system that Bitcoin is, that could be very healthy competition. Basically, if investors or don't like what the Fed is doing or the government is doing generally, they can increase their hedge in the form of a private money. Now, in terms of monetary policy today, what do we see? Well, we got the June update for M1. It's now up 1% on a year-over-year basis. So no longer declining. We went through almost 2 years, I think, of declining money on a year-over-year basis, certainly 1.5. So in the second quarter, let's just say money growth on a year-over-year basis was in the 0 to 1% range. GDP was close to, on a nominal GDP, on a year-over-year basis, close to 6%. Velocity is therefore around 5 to 6%. The velocity of money is the rate at which it turns over. If we're right, and this cathartic moment, slowly and then all at once, causes consumers and businesses to hold off and say, okay, let me see what's going to happen here. Let me see if interest rates are going to fall. Or maybe the better way to say that, the probability that interest rates are going to fall has increased significantly here. And so if you know interest rates are going to fall, and now there's conjecture it could be 50 basis points in September, and then another 25 to 50 basis points in November or December, maybe both. If you're thinking that way and you're being educated by the media that that's possible, what are you going to do? You're going to wait for the lowest possible rate. Same thing with prices, and this is the deflation. This is where it gets a little concerning. If you believe prices are going to continue falling, you'll wait. And that lowers the velocity of money. So here we are. This is what really does cause a recession, when the velocity of money seizes up. Everybody says, wait, let me wait and see what's going to happen here. The history of falling rates is they are followed by a recession. The Fed is reacting. And very often, the NBER, the National Bureau of Economic Research, which a year or two later backdates a recession, that interest rate cut has usually taken place, when all is said and done, in the middle of a recession. So we could be a good way through it when the history books are written. At this point in time, be pretty much through it.
The U.S. Federal Reserve has been widely criticized for using lagging indicators in its monetary policy decisions. While many see this as a sign of incompetence, Real Vision founder and CEO Raoul argues that it's all part of a deliberate strategy. According to Powell, central banks agreed in 2008 to debase their fiat currencies to prevent a global economic collapse during the Great Financial Crisis. He believes that recent aggressive rate hikes are consistent with this long-term plan. In the wake of recent stock market turmoil, Powell shared his views on social media, asserting that the situation was premeditated. He suggested that the central bank's actions would eventually lead to lower interest rates and a need for increased liquidity to manage debt refinancing. Powell likens these market disruptions to previous episodes like the 2018 taper tantrum, where severe but short-lived asset liquidations were followed by a resurgence in liquidity. Powell also noted that the recent revaluation of the Japanese yen is part of a coordinated effort by central banks to inject liquidity and revive global economic growth. He argues that a weaker dollar is crucial for easing financial conditions and resolving the current market turmoil. Powell's analysis suggests that these moves are all planned, leading to more liquidity, higher prices, and further debasement of fiat currencies. Do you agree with his perspective? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.